All right, the joys and perils of live streaming in the hands of a noob live streamer. All right, so I have obviously lowered the latency. There's 3 settings on YouTube's live stream studio. It's normal latency, low, and like ultra something, whatever. And I had it on low, which was the middle setting. And I saw some of you tweeting to me that it was like glitching and skipping and such. So I have it set to normal. So understand that that is obviously going to cause room for those to say I'm broadcasting on a delay and somehow still being able to manipulate time and space and say things, differently after I've already spoke it into the ether. So I'm never going to make everybody happy. I'm trying. I'm trying. All right. So give me a 5x5 if you can hear me now without any issues on Twitter. Just tweet to me if you can hear everything. Thank you, dear Fug. All right, so we are. I'm gonna go back over to the chart so I can see what I'm supposed to be looking at here. All right, on the left-hand side, again, this is the E-mini S&P. Just real quick, I will be deleting the previous attempt at the live stream because it's glitched, okay, and it's gonna have an issue with obviously drawing people's attention to something that only lasted for like 3 minutes, and I had to restart the stream. So I usually don't like to have anything missing or deleted, so it really wasn't a complete event or a broadcast for me. So that will be removed, and this one hopefully will be without any issues technically. The time right now is New York local time, 13 minutes after 9 a.m. Left hand side we have S&P daily chart, September contract for 2023. Right hand side daily chart for Nasdaq, September contract 2023. And I want you to know that obviously I'm talking for the benefit of you all that are willing to sit here and listen, but this is for my youngest. So we're sitting here, we're looking at things over charts, and I homeschool him, and this is part of the things that I require and have him inquire on a daily basis to look at price. These are things that I want him to be observing. These are also something that would be beneficial for you as well while you're looking at price action. And today is a day where we have no bias, but we're going to use intraday volatility so that way we can try to read the tape and look for conditions in the marketplace where the algorithm will leave clues as to what it wants to do and what it should respect and what it shouldn't respect. So I'll go through it as we go along here, but I have a time limit. We'll cut off at no later than 11 o'clock. But if I'm satisfied for whatever I share with you today prior to that, just be content with that. Okay, it's not like a 4-hour session. He has other things he has to do with his homeschooling, so I don't want to burn his entire day. He likes to play video games, so we made a deal. He learns how to do this well, he gets an extra hour and a half each day in gaming. All right, so real quick, I don't know yet. I'm going to try to look at this as I do it with you live to determine what I'm going to focus on specifically this morning, whether it be the ES on the left or the Nasdaq. And a lot of questions I get many times is, which one do I pick? Which one do I know is the one I want to be following for at that trading session or that particular day? And these are some of the things I go through. It's not obviously a complete list of things, but it's a down and dirty, quick. If I, like, for instance, show up to the charts late. Okay, something happens. My wife needs my attention elsewhere. An important phone call or traffic. Say I was out somewhere. Long story short, I'm not in front of my charts. I overslept. Okay, I'm human. Some things like that is going to happen. And I sit down. I haven't done any pre-market analysis. I haven't done anything that would lend well to determining what I want to do just yet. So if I sit down and I haven't done any pre-market analysis, I haven't done anything that would lend well to determining what I want to do just yet. So if I sit down and I haven't done any pre-market analysis, I haven't done anything that would lend well to determining what I want to do just yet. So If that happens, one of the things I do is I go right back to the daily chart and I look at what is obvious. What has it done? What has it left in price? What has it disrespected? And I'll kind of like point those things out that is salient to me. You may see things here while I'm going through the price action that your attention gravitates to because it's something I taught, and because my mind is keyed up on very specific things, either subconsciously or I have a premeditated idea about what I want to do. And admittedly, I'm telling you up front, I don't know just yet what I want to do this morning. I don't know if I want to go short. I don't know if I want to go long. I don't know what the bias is at this very moment. We just came off the heels of a holiday. The morning session after a holiday is just like a big, large trending or large range daily candle. The very next morning session, you have to play your cards very, very carefully. And don't be in a rush to plunk down and ante up a big trade because it might do things that you don't expect. And in a day after a holiday, where like a bank holiday, and yesterday the United States celebrated the Labor Day holiday. So we had a very abbreviated trading session. I was able to take $2,100 out of Nasdaq going short, and I'll show you what I was doing yesterday in regards to that too. But that was just to show, again, my youngest, that price still will deliver even on holidays. But I tell him when I'm talking to you all, because you're new, because you are lacking experience, you haven't been doing it very long, and the impulsiveness of wanting to make money, getting out there trying to get funded accounts, get payouts, and trade a real account before you're ready. I try to do my best to slow you down so that way you don't hurt yourself prematurely. You're going to hurt yourself. You're going to have losing trades. But it's important to stay motivated and not lose interest because of the adversities that this industry is going to present to you anyway. So with all that out of the way, just know that what I'm suggesting to you today, if you are listening and you're trying to do a funded challenge, because I saw 2 people post on Twitter to me that you're trying to do a challenge today. Do not, absolutely do not take anything I'm going to talk about today as an invitation for you to go in there and take a trade. Do not let me influence your trade. If you're trying to do a funded account today, turn this live stream off. It'll be able to be played later on. It'll be on the YouTube channel. Don't let me influence your analysis. It's very, very important that you do all of your trades with your own analysis and you trust yourself, because I'm probably going to say something that's going to go against what you want to do. And if you miss a trade, or if you are influenced by me and it causes you to miss a move or take a loss, you're going to find a way to blame it on me, when none of that is my fault. It's you listening to outside noise. And right now, I'm talking to my youngest son just in front of you. Okay, so just be mindful that the responsibility still is solely in your hands. All right, so right away on the left-hand side, I'm annotating this area here. See this candle right here? This one here, the low of that candle, which I'll move this out of the way so my son can see exactly what I'm talking about. This candle's low. If you look up here, these numbers here, that figure right there, that's the low, 45.91 even. So that's what I'm drawing this box over to and anchoring it to that. And then this candle here, its high, which is right above the cursor, that high is 45.47.5. So this is a fair value gap. It's in the form of a SIBI, sell side imbalance, buy side inefficiency. Easiest way to remember that is a SIBI is a down candle that makes the fair value gap. A BISI is a up close candle, fair value gap. Okay, it's real easy to remember that. Does that make sense to you? It's okay. Unless you talk, they won't hear you, son. The idea is that the market will revisit this area, and we bumped up into it here. This candle's high. Again, you're looking at this number right there. This candle's high comes in at 45.47 3/4, and again, this candle over here comes in at 45.47.5. Can you see how that went up 1/4 of a point higher on this candle right there? So it bumped up on that on Friday. So it touched it and then retraced lower. Inside of this area here, so this was like the premium, like how far it can go up while it was going here. Not to say it can't go any higher, but for right now, we're just doing early before the market opens up analysis. See the candle here, this bar? Where it stopped is this line right here. That's the closing price, and you'll see that right there. That closing price and the very next candle's opening price, which is this one here, there's a distinction between the two where there's no body, no other candle body that overlapped between this candle's close and this candle's opening. This right here is what Daddy calls a volume imbalance. Sorry guys, I'm wearing a dad hat today too. All right, and there is the volume imbalance. So the market will want to go back into this area, and it can do it multiple times. Until we get a body that lays over top of it, I won't ignore it. It'll be useful in lower time frame charts because this is a daily chart right now. So if we drop into lower time frames, you can see the influence that this has had as like a magnet on price. Okay, so it'll pull price down to it, and if it ever gets below it, it might pull it up to it again until there's a body that lays over top and between these two lines. Okay. This wick here, midpoint on that, that's important to me. So we're going to use the 34.75 level. We'll highlight that. For shorts, I want to see price stay below. That means when Dad thinks it's going to go lower, I don't want to see it go above for S&P. I don't want to see it go above this red line. It can touch it today. It can poke through it, but it can't do it a lot, but it has to come right back below if it does. As long as it's doing that, then that'll expect it to eventually roll over and try to trade below this candle's low. But using these lines here intraday today between this red line and these two blue lines. So I want to try to use these two reference points just for the S&P. This one here, because this one on the left is not the same as the one on the right. It's two different markets, two different trading vehicles. So we're going to use that. We're going to drop down into a 60-minute chart. And we're about 6 minutes away from the opening bell. So right away we have this area in here. So this is an inefficiency that has a fair value gap with a down closed candle. So down closed candle fair value gap is a SIBI, sell side imbalance, buy side inefficiency. Right above these highs here is a buy side liquidity pool. That means there's buy stops right above that. Okay, so now that's annotated. And over here, I have some of the, because I've been really worried about this one more so than that one. So I've been interested in Nasdaq versus the ES. Not that it's any better or less profitable, just my attention's been on this one. But we had the same thing here for the daily chart. This is a fair value gap in the form of a sell side imbalance, buy side inefficiency, or SIBI. So we traded up into that, and half of that gap between this candle's low, that candle's high right there, split that in half, and the way you do that is you get your fib, put it on the highest and the lowest point, and you can see that that's what that line is there. So that calls that consequent encroachment, just the midpoint of that range. So we traded above that on Friday, and then we bumped into the low end of that SIBI again today, trade up into it, and then went lower than Friday's low right here. And then we have this candle right there, that low, this candle's opening where the body starts before it goes down. All these two levels here, this level here and this level here, I like those levels. If we lose the intraday low today, and that means the lowest low it made today so far. Right now we're still in the daily chart. This box here is just showing up because I didn't set the right settings for showing what I want to show on each individual chart, and you'll see what I mean by it in a minute. But I'm watching how we behave with the buy side here. So it looks like we're using these two lines. Remember what this was? These are the volume imbalance lines from the daily chart. So we were working down inside that. We did it here. So the market will likely want to go up and take the buy stops here for people that are making money or have made money going down and haven't got out of their trade yet. There's buy stops above here as well. And it's just before getting to that wick, the midpoint of that wick on the daily chart. Remember I showed you that red line here? So it's likely to trade up into that, and I want to see if it trades above here, does it respect the midpoint of that wick? Now, let me show you what I mean, because you're looking at me like I'm that wick right there. See it? So half of that. That's like the line in the sand Dad calls it. Like, I don't want to see it go above that. If I want to see shorts today, the best case scenario is that we stay below that line here. It can tap it and just make a little bit of movement above it, but I don't want to see it go above it and have a candle body lay over top of it here. So because we're directionless, we have to frame everything on the context of the higher time frame daily chart, what it can reach for, and still have really no directional bias. And then we go into the lower time frames, jumping from daily right down into the 60-minute 1 hour chart. And we find any inefficiency. Right here's where price is now. Buy stops above it are here. The inefficiencies here, and then we have buy stops here. So that's going to take this and make that the same thing. It's buy stops or buy side liquidity. So it can draw up to here as long as it doesn't go above this red line. I won't. It won't change my mind to anticipate lower prices as long as we don't go above on a closing basis on the hourly chart above this red level. Okay. So on the downside, we have potential sell side liquidity that might get revisited today here. Okay, and that's about it for right now. Because we had all these big lines underneath the candles, these are tails, and above the body is what we call a wick. But Dad sometimes messes up and calls them wicks on both ends. It's probably going to happen when I'm talking today, so don't let that confuse you. If we didn't have all of this here, I would like to use this. See the difference between this candle's low and this candle's high? That right there is a gap. It's called a SIBI because it's a down closed candle. So if this wasn't here, like if we didn't have all this in here, I would use this as an inversion fair value gap, meaning that now we're above it, it should act as support to go here. But because we have all these tails underneath it, I like to see these things fail. In other words, other traders might see this and say, okay, it's support, and it's building a case for higher prices, and that might be true, but I don't suspect it's always the case. So while it might use this area here, like it looks like it's done here, it might run the buy stops here and then maybe reach up into this area to knock out people that are trading it to go short. How we trade at this level, or if we get to this level here, is more important to me for S&P. So because I say this, I'm not so interested in ES. My attention is still on this one. So let's quickly jump into the 60-minute chart. We have a gap here. in time, you'll appreciate how the information I just shared about holidays, when they don't let the market trade because it's a federal holiday or the equivalent, that sometimes causes the market to be uncertain as soon as it starts trading the next business day. Obviously, it's been trading overnight, and that is, in my opinion, not all that terribly important. I want to see what we're doing after the opening bell, and it rang a minute and a half ago. So we have buy stops here, buy stops here. Okay. And you can see how it hit the bottom of this area here. I want to show you what that is. When this ran up like this on Friday, part of this run here on the lower time frame, you're going to see there is, just like this is here on the downside, in other words, this candle's going down, you're going to see the opposite over here with a green candle, which makes it a fair value gap. It's an up close candle, meaning it's a BISI, but it acts as an inversion. Inversion fair value gap. All of this inefficiency here. Notice how this stops right in the middle of this here. It doesn't look like it's anchored to anything, right? Now watch what happens when I drop down to a 1 minute chart. See how the market hasn't really done a whole lot yet? It's been back and forth. That's what usually happens right after a holiday in the morning, because everybody's in there trying to figure out what they want to do with their money. That's scrolling back to Friday. This is the part of the time where people that know how to use TradingView better than Daddy, they're wishing they could tell me, do this, ICT. All right, so you can see right here, that gray shaded area is in where Dad was showing you. It's this candle's high and this candle's low. And I'm not sure why it always moves these rectangles around, but it's this inefficiency here, because it's an up candle, it's green, and it's one single candle between two candles. That makes it a fair value gap, and it's a BISI. An up close candle, fair value gap, is a buy side imbalance, sell side inefficiency. But if we're bearish, like we were over here and Dad went short on Friday, and for the folks that didn't watch that on YouTube, I did record that live trade. It's with real money, not demo, and not a funded account challenge, and not a funded account combine or past. It's a real brokerage firm. But this area here is this right there. And while I wanted it to go lower on Friday, notice how it comes right back up to half, which is what this line is here. So if you take this tool, this is the Fibonacci, you lay it on top here, and drop it on that low, and it's measuring half. So if you take that off now, you can see why that dashed line is there. And look what the price did. It went up to it, just like a force field. It hits it. It doesn't want to go higher. It goes away and comes back one more time. See where this little line above, that's the wick. It goes above it, but the bodies, look where the bodies are lining up with. Half of that 1 minute inefficiency. So that's the stuff that Dad's students get crazy about. It's beautiful. Hits it, sells off, and then works lower, and then look at these lows down here. This is what Dad's been talking about also before we got on this today. Whenever there's lows that are real close to each other in terms of where they are, where they stop, that means there's going to be this right here. This is called sell side here. Sell orders below old lows. Same thing here, and that's where the market gravitated to. So we left the buy stops here on the S&P. Look at the bodies respecting that inefficiency that I just drew. You see that? These are called signatures. Okay, they're just little reminders that the market's not random, and there's a computer that's running scenarios for price to only reach to a predetermined level, and then it will stop it, slow it down, and then either continuation or it'll reverse. In this case, you can see it's drawing back down into those two levels I talked about, which is a volume imbalance. You see how it's drawing down into that? We went completely over top of all these wicks. Remember I was saying earlier about how other people that doesn't use what Daddy teaches, they see this stuff as bullish. It means it's, remember I talked to you about the bullish and the bearish? In California, they had bull and bear fights, and the bull would gore with his horns up. That makes it a bull market. And a bear would fight the bull by slashing down with its claws. Everyone else that doesn't use Daddy stuff will see this here, see these wicks. Or, say I just did it again, remember I told you that? This is the tail on the candles. I don't look at that just because it's doing it because everyone else has books or they see it and they think it's going to go higher because of that. There has to be something else there for me. So I look at that as it's a suspect conclusion for anyone to look at that and think that that means it's going to go higher. I demand more information. Like I said earlier, it could do it, but I'm not willing to subscribe to that yet. So I want to see how it behaves once it trades to this line, midpoint again, or the lower level. Until it does that, I'm not interested at all in touching ES. But back over here on Nasdaq, we'll go back up to the 60-minute chart. All right, so we are inside of this blue rectangle here. Let me go up to the daily chart because I want you to understand what that is. It's this little fair value gap here. So between this candle's high, that's this price right here, you see it? Watch that one. That candle's high is 15,430.50. And in this candle right here, its low, which is this value right there. That candle's low, 15,460 even. It means 0.00. That separation between this candle's movement up, the previous candle stopped at that point, and the next candle after this one stopped here. So there's a little area right there that it only went one direction on this particular time frame. It means it went up. That is a fair value gap. What kind of fair value gap is it? If it's an up close candle, it's a buy side imbalance, sell side inefficiency. Real easy to remember. Okay, so that blue box is framed on that, and I'm just highlighting Friday's low here with this line. That's what that line is. And then we'll look at this shaded box here, which is on the daily chart. Go down to the 60-minute, 1-hour chart again. So we're digging into that daily fair value gap, and we went right below this candle's closing price. And look at this price right there. That is a rejection block. So it went down below it once more, and even the lowest movement here didn't breach or go below the midpoint of that candle's tail. So we measure that to here. See how it went real close to it but didn't go below it? So because it's doing it, I like the Nasdaq to take the buy side here and maybe run up into this little area right there. I like that more than I like the S&P. Meaning that this one could go above this high here and trade into here before this one starts to behave and go up into it. So in other words, this is like it's like the one that's in a hurry. So if it's going to go higher, the Nasdaq's going to go up faster to where it would go to if it was going to go up before the ES on the left-hand side would do it. That's what I'm saying. Okay, so it's kind of like the tortoise versus the hare. The hare is the Nasdaq. It wants to run real quick and get it over with. So that's what we're looking at here. So we'll drop down into a 15-minute time frame. Okay, you can see how messy it is. See, it's back and forth, back and forth, back and forth. This is what you try to avoid trading in. You don't want to look at markets like this and think, I have to find a trade to get in there and try to make money. Because if you do that, number one, you're gambling. And when I tell you about that, you don't gamble and find consistency doing that. You don't consistently get lucky. That's not what we're trying to do. We're consistently looking for things that make sense, that's easy to see how the market wants to go one direction over another. So if it's not obvious that it wants to go higher to a very specific level, we don't try to go long. If it's not obviously trying to reach for something below the marketplace, like a fair value gap below price, or an old low below price, if it's not obvious that it wants to go down there, we don't take a trade. Everybody else is going to be in here trying to do something because they had half a day of trading yesterday, or they didn't trade at all because it was a holiday, which is good. But their impatience is going to lead them to do something they're probably not going to be thankful for later on today. They'll probably end up taking a losing trade. And one of the things that teaches is to try to be real patient, not do anything in a hurry. Don't try to go in and try to make money every single day. Look what we're doing over here in the S&P. See the difference? See what Dad just explained this, and it happened. This one's not trying to go higher, while this one went a little bit higher, but this one went right back into the daily volume imbalance. The lines in here went right down to the low of it. So watch this rejection block, this candle's close. So in other words, the lowest closing price, while all the candles were going down, right before we turned higher here, that price right there. I'll use this one. Let's see how this influences price, if at all. One of the things that I want you boys to learn is if the markets you're trading that are real close to one another, if in other words they move together in the same direction, that's what Dad talks about in correlation. Correlation means if A and B are real close to one another, A and B should move up together. If one starts to move higher, either the other one starts to follow it in sympathy, or if it doesn't, that means that you might get a trade set up in the one that you think is stronger, but you don't use a lot of leverage. That means put a lot of money behind that type of trade. You want to use your maximum or your standard amount of risk, which we call it leverage. And Dad was talking about how you have this much in your account. This is what you can risk total, and then how many contracts can you trade with that if you're using 1%. Well, if your maximum is 1%, you can't do that type of trade if the markets are not in agreement. That means the correlation is off. Right here, we're seeing there's a crack in the correlation. See, we're just getting ready to go right below that rejection block. Wait, watch this right here. Let me finish typing this out because they're probably wondering what the hell I'm doing. All right, let's put it over here on the right-hand side. All right, so now we went below here while the Nasdaq is up here, hanging around just above that daily shaded blue area, which is the fair value gap. Do we reject this and go higher and start to get in sync with what the Nasdaq was doing, or do we see the Nasdaq lose ground here and go for this low? That's what we're watching. Okay, we're trying to get a determination what is more likely. There is no trade for Dad to take here. There's nothing for Dad to enter on. There's nothing that you would be taking a trade on. But knowing that this is what it's like, you can anticipate. You can anticipate when the market is likely to create problematic conditions where it's real hard to trust setups and not know where it's going to go because it's after a holiday. That's just marking the midpoint of that wick right here. Okay, I'm gonna make these a little bit thicker because the lines are starting to blur together for Dad. So I'm gonna These are daily levels and their volume imbalance levels. You see what's going on with Nasdaq? It's finding support at the top of that fair value gap on the daily chart. Maybe scrunch this up a little bit. We'll put those levels and highlight right here. So there's buy side here, and there's buy side right here. On the ES, notice where the bodies went down into that volume imbalance, right below an old low. And look how these highs right here, are they close to one another? In other words, they're not the same price, but they're real close to one another. So what do we call that? Relative equal highs. So right above that would be buy side. So because there's no bias and we're just looking at intraday volatility without any impulsiveness to want to press the button, the importance of this today is for you to see what Dad was talking about last night. When we sit down and we look at this, because it was a holiday yesterday, the very next morning session is going to create this static price action where it goes up and down, up and down, up and down. You see like that? So you don't want to try to assume or push your will into the marketplace on that day. Making yourself believe that there's going to be a big move that's going to run real easy from one direction to the other, or one level to the other, without having all of this back and forth, up and down. See what the Nasdaq is doing? Up, down, up, down, up. So it's staying in this little area. It's respecting that blue shaded area on the daily chart, which is the fair value gap. But is it getting right to this area here where there's buy stops easily, just like that real quick? No. Dad suspects that it will, but even if it doesn't, or if it does, it means nothing. It doesn't mean there's a trade there. Put that one over there. Let's go down to a 5-minute chart. Now you see what I did? All I did was wrote down the numbers on these levels here. That's what that has on the piece of paper right here. This is all I have. And I'm putting this on there for them to follow along with what I'm describing to you. You see the paper, but they're looking at the chart so that way they can go right into the chart and see what it is I'm referring to. So you're getting both, like, why, when you ask me all the time, what are those numbers on this piece of paper all the time? It's these levels here. And I'm writing the time frame that I'm noticing it on. That's what the middle number is, okay? So like 15M and 60M, that's the time frame. That means that whatever the chart was set at when I saw it, that level is important to me there. That's all it is. Now look at what we have here. Same time frame. This is a 5-minute chart on Nasdaq. And this is a 5-minute chart over here on the S&P. See these lows here? They're not matching. Lower in S&P, but higher in Nasdaq. See that? See these highs here? We're seeing lower on S&P. That is the biggest clue that you should not be trading right now, because you're getting both sides showing SMT. Okay, it means they're not in agreement. A symmetrical market, or a market that is easily traded, that means that they'll have runs that go real quick in price, that just simply just move real nice. That calls it a low resistance liquidity run. This is hardly the environment for that to occur, because we're seeing opposing failed higher high on the S&P that the Nasdaq was able to do over here. Lower lows in S&P were not met with lower lows on the Nasdaq. So these are higher respectively versus over here. So what does that tell you? It tells you that there's a crack in correlation, but not in the sense that like if we have a directional bias and there's a crack in correlation. If we're bullish and we think that the market's going to go up, if Dad sees the S&P make a lower low and Nasdaq not make a lower low, and it's at a level that's important like I've shown you here, I'll buy that because that crack in correlation means something. It's significant. Much like this is here where we have no bias. It's on the morning session after a holiday where we expect uncertainty. We expect all of this type of movement back and forth. This is expected. Dad students that's been with me for a long time, they know that this is likely to occur just like this. But it's further evidenced by having the market not agree on the highs and the lows intraday. So you have to sit on your hands. This is the part where new traders, and when Daddy was younger, I wanted to be in there a lot. Like I wanted to be in there all the time, pushing the button, pushing the button, pushing the button. And that's not what you want to do on a day like today. You have to sit still and let the market work out what it wants to do. Right now, everybody else is trying to do something. And that's creating sentiment. Sentiment is the view collectively what the market thinks is going to happen, which many times is not the actual case. It usually does the opposite. Or does nothing, just goes sideways. Either or, it frustrates them. So see what S&P is doing over here? We have a high, a low, then a higher high. This down closed candle here, we traded up into that, but also to the high of the volume imbalance on the daily chart. So I'm looking at this with interest that do we respect that and go lower to trade into that wick that I highlighted here? And if it goes below that, the sell side resting below here. Why am I talking about that one like that? Because this is showing an unwillingness to go higher on these highs like the Nasdaq did. It's moved lower when the Nasdaq consolidated and moved higher. So that means weaker or stronger. Is ES weaker or stronger than the Nasdaq? It's weaker. So it's likely, it's more likely, doesn't mean it has to do it this way, but it's more likely to respect this if it's going to go lower, to reach into the wick, consequent encroachment, and or the sell side liquidity here. And then if it does that, that might cause the Nasdaq to rotate over, even though it has the higher high here. It might still roll over and attack its sell side here. And there's a small little, see that little gap right there? Dad's eyes jumping right to that. Right here, because right below this is sell side. Like this is it, like that does it over here. This is a level where sell stops would be. And there's a little inefficiency right there. And that's a buy side of L, sell side inefficiency. So I'm just going to put that on the chart because if it does roll, that would be something to watch here. There's no risk. That can't lose anything here, can't make anything here. We're just observing this price reach for that. And it's a good study. I'm just going to extend right. And the problem is where would, if say for instance that's corrected, it might roll down into this low, take out the sell side, and then go into this little inefficiency. If I'm right, there's no way that I can comfortably navigate all of this here and place a stop that's very small, because we're trading at 473 now, and the stop would have to be above here. And it's too much risk on a day that doesn't have it doesn't have a lot of market structure to support the idea. So you have to be content with just observing and price action, and that's it. Just sit and watch. Even though you don't take trades on days like this, even though you don't, potentially make money or lose money, which is the benefit, you're not losing anything. These are days where many times you'll look back and say, I'm glad I didn't trade, but I learned a lot about myself and I learned a lot about what price is likely to do without any pain. No pain. So this is what Dad talks about in tape reading. We're not pushing any buttons. We're just observing how price will behave. We had multiple times to go higher, higher, higher. S&P's heavy. It's having a hard time getting above the daily volume imbalance. That's these two blue levels here. And if this thing rolls down, this will draw Nasdaq down into this low right there and right into this little tiny little pocket of price where, looking back from here, you can see how there was a fair value gap there. We traded down into it. There's no fair value gap in here until that small little section there. But that right there is just above this low. So if it's going to go to here, it's going to probably wipe out the low because there's stops there. Real orders are resting right below that. So that means people that are trying to go up to make money, they probably move their stop loss from below here to there. So the market has two reasons to want to go down there, to take the sell stops below this low, and the market will want to clean up this inefficiency right there. Even though that's a small little insignificant little separation between two candles on a 5-minute basis, that inefficiency is useful for offering a efficient market. That's what the algorithm's trying to do. It's trying to facilitate efficient market delivery. It's not anything other than that. We're about 2 minutes away from 10 o'clock. So the first 30 minutes, that calls at the opening range. And whatever liquidity is established at that point, we use that going forward into 11 o'clock. Any inefficiency, like fair value gaps, we use that going into 11 o'clock. Now, as it's dropping, my eye's going to the S&P over here. I'm watching how it behaves once it hits the level here, which is that midpoint of that old candle's tail. So it's the midpoint of it, consequent encroachment, before we drop down into the lower time frame. And then I want to see if we get there on the S&P, how are we trading at this low, if at all? Are we in agreement with both these levels being taken at the same time, or if this goes to it first because it's the weaker of the two, like the ES is weaker, it means it's more likely to go where down, as it's indicating here in the chart. The Nasdaq's trying to say, I don't want to go down there. I don't want to go down there. I don't want to go down there. So it's showing its strength when the S&P stops going down. You see that? When this one stops reaching lower, this one's starting to show its strength. So what I do is I'm measuring constantly back and forth, observing how price is delivering relative to one another, because even though everything's are between these two markets, the ES on the left-hand side and the Nasdaq on the right-hand side, because they're disjointed, that means they're not moving together. You know, they're not in tandem together. They're not moving the same direction as they would normally, which is a symmetrical market. Because it's not happening, we wait for a shift intraday. There's a time where that no longer is a factor and they begin to move in sync together. That's what I wait for. Like, I'm observing that once the inefficiencies, or not inefficiencies, but the lack of symmetry is overcome after a holiday, once it's reestablished, that means everything starts to be calibrated again. They move in tandem once more. Then it's easy to trust and or anticipate the market becoming symmetrical throughout the remainder of that trading day or the very next trading day. So it's not a matter of just expecting the fact that it's going to be sloppy the next morning session after a holiday. It's you need to be observing price, real-time best case scenario. But if you can't, at least go through your intraday charts like that's shown here and look for when it did shift where they move in tandem. Once that occurs, even though you may be looking at it after the fact, maybe waking up or finishing school, or for people that are students, they have a business, or students or employees somewhere, they can look at their old data after the fact in hindsight and say, okay, at this time of the day, which has not happened yet, there's no symmetry yet, but whenever it does occur, they can note that in their journal and say, okay, now I can trust that it will be symmetrical the next trading day or next trading session. If it happens to sort itself out this morning, then the PM session, between 1:30 and 2 o'clock, in that time period, that begins our PM session going into the close of the day at 4 o'clock. Oh, there is some. No, on the left side of it. Okay. Forgot to have the power closed. These are the types of teachings that today's people online that are trying to learn how to trade, these are not the lessons, and I'm sure this is not going to be something that you're going to remember. But I wanted you to sit down with me this morning and see what I mean by how it's an ugly morning session. It will be choppy. It won't really want to do a whole lot. But these are the days that are going to hurt you and hurt everyone else that don't understand it. Because you'll want to do something, and you'll get frustrated sitting here waiting for something to happen. And you're like, oh, well, whatever, I'll just go in here and click the button. And Dad did that when I was younger. I did it a lot. It wears you down. Where it's just easier to have, I know it's likely to do this, so this must not have any impulsive tendencies creep in. There's no, like if you look down here, see how I have it on the trading panel? That means Dad's account, not even a paper trading account, not the real account with AMP, nothing. There's no way that I can even push any buttons that cause anything to happen here at all, which is how you want to observe price when you're tape reading. Don't have any invitation or access to, I mean, not that you can't do it, obviously. If Dad wanted to put it up here, it takes a second or two to pull it up, but you make no allowance for that. You know what I mean? I'm not saying that it can't be done, but if you're going to study with the purpose in mind that you're going to study just to read the tape, to learn, to trust that you don't have to rush in after there's a holiday. Like everybody else out there, they're going to want to get out here and do something because they were prevented trading a full day yesterday. And because they're gamblers at heart, they're really chomping at the bit right now. And I'm certain there's going to be people that have already tried to get into a trade today and they're regretting it. Whereas what I'm teaching you, it teaches you, number one, you're never going to fear missing out. You're never going to feel impulsive. You're going to learn to trust what Dad's teaching you. You're going to learn this, and you'll know that these things repeat over and over and over again. And if they repeat, that means they're controlled. And if they're controlled, that means everything Dad's shown you will hold up, and it'll happen in the future just like it's been happening for us, as long as you've seen it. That's one of the things Dad you see on the emails all the time and the comments on the videos I show you all the time. It's funny, and how they think, is this going to stop working? Is this going to stop working? It's not going to stop working. Give me that other pen. That one. Yeah. All right, you see where Nasdaq is now? The one on the right? We're down into that blue shaded area. We dug in there a little bit deeper. We went right below this low, right there. And this entire wick, this little line below the body of that black candle right there, all this running right back up there. I want to see how we respond right now. Does it rip through it higher and reject this little fair value gap? Or does it go above that and then start using this fair value gap as support? Because this is essentially half of that blue shaded area, this movement right in here. One of the things that you learn painfully is if you know that there's a lower degree of probability, if there's the odds of it being stacked against you more than normal on a particular trading day or trading session, and you ignore that and you just go in impulsively, still try to trade it, the day that you do that and you take a loss, I don't care if it's like a small loss, like a real insignificant, a little bit amount of money, that will cause a great anger. You'll get mad, you'll regret it, you'll have remorse, and you'll want to fix it. And that's the days that people usually go into a tailspin and they lose more, and they lose more, and they lose more, and they lose more, and eventually either hurt themselves to the point where they can't trade anymore until they put more and more money in, or they become scared to take the trade the next trading day because they hurt themselves too much. So it's important to know these lessons because it keeps your mind thinking about the right way of trading it and looking, anticipating price to behave a certain way, not be surprised that an average person looking at price today would be like, oh, this is chop, we're going to sit with it and still look for a setup because they want to do something. You know what I'm saying? Like, I'm not saying that people can't find a setup in this. I'm sure somebody out here got lucky, and wants to call it skill. But this is manipulation. This is what this is. It's not a lack of people wanting to buy and sell. Because if it was buying and selling pressure, and if that was the case that causes markets go up and down, the market would be moving. This is manipulation. They're holding it until a bigger magnitude of sentiment is in play. Excessively bullish, excessively bearish. Once that occurs, then the market is allowed to unravel and run against, where the majority of the money that could be lost in current sentiment, then it'll run. That's what goes on after holidays. That's the mechanism. That's exactly what this algorithm is designed to do. It does it all the time. Unless some geopolitical thing comes into the marketplace or hits the news wires, that's generally what ends up happening. And we're seeing it here today. So does this make you want to like go in here and say, oh, okay, I think it's going to go higher? Does it make you feel like it wants to go lower? He's pointing down, and I think it's because he sees that I did this, so he's just assuming because I have it down here, he thinks I'm going to be right about it going there, so he's saying down. It might not go down there, but what my question was to you is, do you feel like you should have known 30 minutes ago, 40 minutes ago? Do you feel like you should have known that it was going to go higher or lower? Right. Shaking your head no. Only because we talked about it already. Because this is a day in a session that we would not expect to do anything in the session because it's after the holiday. So the very first opportunity for traders to get out here and trade with real money again, because they had to stay out yesterday. Now they think I only have 4 days left in this week, today, tomorrow, Thursday, and Friday. So greed is hitting them really, really hard. Impatience is hitting them really, really hard. And whatever they use to trade with may or may not be in price action. What we're seeing here in the candlesticks. So they're going to be impulsive, reckless, and go out there and just simply just push a button and hope that something happens for them favorably. And that is gambling. Now watch this gap. Remember I was telling you I wanted to see once we got up over top of this wick here, do we run through this gap? And if we do, does it treat it as support? So we're going to take this little box thing over here. Okay. Watch and see. If we lose this again, goes below it and comes back up and hits it and reacts to it as like resistance, we start to sell off in the S&P, that would be favorable for it to go here. But right now it looks like the S&P may want to go back up and revisit this volume imbalance right in here. Even though this candle went right above it, it's only a wick. So I think we'll probably draw up into that on the S&P, and that'll be like allowing Nasdaq to reach up into this buy side here. Let's take these other lines off. Whoops, didn't do that one. So today is a lesson on learning how to preserve capital. That means keep your money in your account. Everyone that loses their account, blows their account, loses or fails to find consistency, they don't know this skill. They don't know where they're going to hurt themselves. They don't know how they're going to hurt themselves. They don't know when the market's going to be unfavorable. They don't know how to predict when the market's going to be unfavorable. They don't know when the market's going to be in consolidation. They don't know when it's going to be choppy. All those things that leads to a losing trade in the hands of a undisciplined person will eventually, given enough time and opportunity sitting in front of the charts, they will draw down their account or blow their account on a day just like this. So it's important that you learn this and understand what it looks like. You see how it's going back and forth, choppiness, up, down, up, down, up, down. That is very frustrating, especially if you want to see it move and you have a trade on. It makes you scared. It makes you feel nauseous sometimes when there's a lot of money behind it and it hasn't moved in your favor and you're afraid it's going to hit your stop loss. The order that when you're in a trade, if it hits it, you're getting out. It forces you out. It might be getting you out with a loss. It may be getting you out with a limited amount of profit. It depends on where you have it at the time when the market trades to it. But today, so far, I'm very pleased that it's doing what it's doing because I wanted you to see exactly what this is. My students know this. It's a general rule. After a holiday, the morning session, you avoid it. Okay, see how we went above here? It just did it with the wick. No body. There was no closing price above that volume imbalance. So this can resume going lower. If it goes back above this high here, that's not going to look at it anymore. We'll close the charts up because I want to see how the ES reaches to this low and or through this. That's the only interest I have on S&P. Now, I say that because it failed to get to the volume imbalance here I mentioned moments ago, and it went above just a little bit the daily volume imbalance. So this right here, I'm viewing that as like a mohawk, like one of those just coloring outside the lines type things. So if this is going to go lower, it should not go back above this level here. If it does, I'm not interested. And I would look at the PM session, 1:30 to 2 o'clock, and Dad and I, and you and Dad will rather sit there and look at it again then. We're not going to be live, so you'll be able to talk to me. There's no reason for you to be so shy. They're not going to bite me, good grief. Don't worry. Once you learn how to do this, you'll get more confident. You'll come out of your shell. Alright, so we have traded back down into this little area here. Now, I'd like to see it just bump the low of that shaded area right there. Just to touch it or have the close of that candle there and then start a new candle and then move lower. I'd like to see that. We went down to the wick, consequent version of that wick. Let me go up to 16-minute chart. Yeah, that level is this candlestick's tail. Okay, the wick below the candle. That's what we had drawn there. It drew down into that. So that's what we see. It drew right down in there. Okay, so without sounding like I'm, grandstanding on the fact that it did a small little movement like this, it's still nonetheless noteworthy because we went above the volume imbalance, but we didn't close above it. And when it did that, you watch how I transitioned. I said, now I'm expecting to trade lower into that wick, which is what it did. That in itself, for some of you, if you were trading at the low of it, when it was trading right there, go back and watch the live stream recording because it'll be on the YouTube channel. From here to get to that level right there, that movement is enough probably for some of you to make more than you earn at your job. Not to invite you to try to trade on days like this, but I'm saying that if we can see that little tiny fluctuation, it's not hard to assume that you can find bigger moves that are predictable. So reach down here on the sell side is the interest for me on S&P, and we should see Nasdaq start to accelerate and reach for the sell side here, and then right into that little pocket right there. If we accelerate through that, then obviously it goes without saying that the sell side will be the next draw on Nasdaq. So there's ways of looking at this stuff without having to push a button, and it's helpful. It's very beneficial to do this because it teaches you patience, number one. It'll also teach you how to identify the strongest setups, and it'll also teach you, by staying out of days like this, it's confidence building. You're navigating in a time where everybody else is just trying to do something, and they're probably not making money, but probably like you're really losing money. So we have another S&P divergence. We went down to consequent quotient on the S&P. Lower lows, higher lows. Which one's stronger? Nasdaq. Which one's weaker? ES. So we got one delivery we expected on the S&P. But if we go back above here now, volume imbalance becomes support, then buy side here. It has to get back above this high, and I'd like to see it touch the volume imbalance high right there. If it hits that, price could spool up into this fair value gap right there, and if it accelerates through that and comes above it, taps it, that'll be inversion fair value gap, and then sends it to the buy side relative equal highs right in here. And that's how I would look for S&P. If it does that, that's going to supercharge the Nasdaq to trade up into its second level of buy side, which is over here. Unless everything unravels, if everything remains the same as it is in terms of the range, that's how I would use the lunch macro. Half of the volume imbalance, we're hitting that right there. It's almost the same as half of that wick too, which is why I was saying it would have to go above this high for me to flip my expectation for this sell side here to be taken. Nasdaq is just being a brat today. You see the bodies? See where they're forming? Right in the midpoint between these two blue lines. So where we go from here is going to be impactful. going to drop down to a 1 minute chart on both. It's a small little volume imbalance right there. So if it comes down and hits that, that could be a sensitive area to see it. If it doesn't take this high out first, so it drops down, hits this area here, I would expect then Nasdaq to take this and expand a little higher, and then pull by its hair S&P higher. We're working at the top of the two blue lines in here. So there's a small little gap right there, and it's also the midpoint of this candlestick's tail. I like both of those levels in agreement, so have 45.16 on your chart. I would like to see it before taking this high out. I would like to see it come down and touch that, and then send it where it's at now. But how we react here, I'd want to see speed through that, and then right up in here. That's the buy side. Okay, see that volume balance right there? If if it hits that, it should hit it and then send it higher up into this area here. So I would like to see it do, unless Nasdaq really just falls out of bed in here. Small little gap right there to trade into as well. Daily volume imbalance. Retrade to it there. If it rallies, see it go back above. If it can treat this area right in here as support, that would be constructive for a run into this little area here. And then how we trade there, to it and through it. If it acts as support there, we want to likely rip up in that buy side. Nothing in this rally up here, like this, after all these lower, I don't look at that as a short. It would need to get back below the volume imbalance, treat it as resistance, break lower, create a fair value gap in the form of a city, so it's going to bounce buy side efficiency, then trade into that. Then I would look for it to run for lower prices. I just don't like where it's at now. 5-minute chart. That sell side there. All over the place, this thing. Rules, baby. Rules keep you in the game. Preserve your capital, your mental capital. Mental capital is the part where you stress. You haven't lost any more money than you would be losing in the trade, or made any more than you would have been, but the amount of time that you worry about. Should I turn the charts off? Should I leave the charts on? Should I take a trade? Should I stay in the trade? Should I move my stop? All that spending mental capital. It's stress, a lot of stress. And when you trade on days that are not like this and everything's firing on all cylinders, that means everything's a symmetrical market. Your model's obvious in the chart, in the price action. You know what you're looking for. It's very, very easy to trade in those conditions. And that's what you want to try to work towards, trading like that. Not everything plus that. No, if you just focus on limiting your trades just to that, that's where you want to be. You won't trade every day, and that's good. That's one of the benefits of doing it the right way, is you're not trading every single day. Because it's stressful, it will cause you to want to do more than is necessary, and that's how you foster the idea of a gambler's mentality. Feeling like, well, I can go in here and make $1,000. I can go in here and make $5,000. So let's just do it. I know I can do it. Even if I take a loss, I'll come back. I'm good. You don't want to do that. Let me check the dollar quick. Took its high out. Look at Euro. It should have really plummeted. In case you guys are wondering, these Forex folks, right down here, quarterly shift. I told you guys we would see this act as resistance, inversion for everybody got hit there. Take a quick look at pound. I know some of you are like, yay, he's looking at Forex. Not that long. This area right in here for pound, I would like it to trade below it, outside of it, come back up and use it as resistance. Not once it goes below it, I don't want to see it go back above half of it. So in other words, go below it, come back up, allow for as much as a return to half of it. Then once it starts to move lower again, lower time frame, 1, 5, 15 minute fair value gaps that are SIBI, use that to maybe study price running into this level down here. Gold. I don't have an opinion on gold. Bitcoin below this low, accelerating down into this inefficiency right there. And how we behave in this will be determining how we get to 10,000 again. But this down here with this fair value gap looks ominous. So there you go. I'm not a crypto trader. I'm just sharing it because I know a lot of people want to know what my opinion is. It's lower. And let's go back to ES. And well, we are back below the daily volume balance. We take the rejection block. We don't need that anymore. All right, see that fair value gap right there? And the low of the volume balance. If it hits that, if it were not a holiday day, if it were not the day right after a holiday in the morning session, I'm not saying you do this. I'm not saying that you should try to do this even with a demo. But I would expect it to sell off right now after it went into that little fair value gap there. Take that and then run into the low on this right here. Oops, gotta go back up to show it on the right. This is the fair value gap right there. And the draw would be down here for me. If it were not holiday, or the AM session after a holiday. Nasdaq's being unruly today. I suspect once we get through today's trading, after we get post-holiday wrinkles out of the marketplace, I think that we'll have a really nice technical week, the remainder of the week, which will be very refreshing because everything will be in alignment. We'll be in a time of the year when it is really liquid. Market symmetry returns in stunning fashion. Speed, all those really good signatures that we look for in price action. Now, let's play devil's advocate for a moment, okay? Say we get below this low, and say we get below the old low here, which is where the sell side is. This low can act as a fulcrum point, okay? A fulcrum point for swing trading here. You can take a fib, take it to the high, down to the low that you suspect is a fulcrum point. And then on your fib, you have to highlight the fib, not that. Highlight the fib and do one standard deviation negative and negative 1/2. And I'll explain why in a second. If we are able to, and if it were to move below this point here, let me move that on. There you go. If it were to break below that, this could act like, let me see if I can come up with that analogy that makes sense here. Say this is a door hinge, okay, and this is the edge of the door, and the door has swung up. If this swings down and below here, it can only reasonably expect to move from this low to this high in the same distance below this low down. That would be this level right here. If I'm in a sell model, which I'm not, I suggested to you already that if it were not the trading day after the holiday and we were not live, I would have taken the short right when it was in here. I would still be short, even where we're at right now, because the stop loss would have to be above the volume imbalance up in here if it were not the holiday or post-holiday. And I would anticipate this low giving way and getting below here. If it were to show speed below this low, which is, again, over here, that low, I would expect it to speed up through that, and then I would want to see speed aggressively into -5 or negative 0.5 standard deviation, which is half of this range from high to low, below this low. Half the trade would come off here, and then the balance would be aimed for here plus the spread, like maybe 2 handles. That's how I would handle that. We're in an indecisive day because we're post-holiday. It's the first morning session after Labor Day's holiday. So you have to be very careful about having very strong convictions like I'm suggesting here. But my model for swing trading, and I taught this on the YouTube channel, I'm looking for these types of setups where if it presents an opportunity for me to be short, I'm looking at market structure in a way where it allows me to frame, if it were to sell off from here and be bearish and go below here, that would be the perfect symmetrical price move, this one down here. So I would want to see that type of delivery. But how I would handle it is I would want to see speed as it drops right into half of the range here. If I was in a sell program, if I was in a market that was bearish, if I was in a day where I didn't have any reservations about how the market may be stagnant like it's shown today, then I would not even worry about this level here. it would just be me going short, no partials below this low, hold for the whole show down here, and just use a trailed stop loss properly. And what I just said to you went over the heads of most of you because you're not listening. You're just wanting me to talk about what it's going to do next. But I literally just described to you the optimal swing traders model. If you know everything else I've talked about on this channel, applying what I just showed you there, you'll know why I'm taking partials on some trades and when I'm not taking them on others. You'll know why I'm saying I'm expecting speed and where I should expect that speed to manifest itself in price. So it can't be just simply taught in like one video or a chapter in a book. It has to be seen with a lot of other supportive lessons. But a fulcrum point is wherever you think if a low is taken out and you're bearish, whatever the previous run was, just take that run and subtract it to the low, and you'll get it. And the way you do that is by putting your Fibonacci on the high to the low, highlight standard deviation -1, and that'll tell you where it's likely to draw down to if it was bearish. If it was going to be in a sell program and it's moving lower, all things equal, the best case scenario exit on a swing trade would be this level down here. Because it's indecisive, I want to see it does it trade below there, take out the sell side here, take out the sell side here. If I were trading today, I'm not, and it wasn't the holiday, you would be counseled to take something below this low as a partial because you're learning to trust it. And then it makes it a lot easier to hold to see if it gets to this point here. And if it does, then you would take a partial there. And then wait and see, does it deliver to go down to here? If it does, wonderful. If it doesn't, you've paid yourself. And that's how you graduate in your experience, you graduate in your understanding, and it gives you the type of experience that you just can't get from watching videos by me or anyone else. Even if I called the trades live in front of you, if I did it for months, if I stopped cold turkey and you didn't learn how to do this, you would feel a great deal of anxiety because now your goose that lays golden eggs is no longer giving you the golden eggs, right? And that's why I teach the way I teach. I want you to be your own golden goose or golden egg goose, like where you determine how many golden eggs you're gonna have. You trust yourself, not me. Don't trust anybody else. See how the bodies inside this area here? Look at the bodies right here. There's just a lack of symmetry between both the markets, so it makes it very difficult to read, at least for a precision basis. So make sure you have that, screenshot that, keep that in your journal, and everything I said, add that to the areas over here. So for your notes, you'll include that. Now, think about what I said earlier. If this was a day that was not post-holiday, my stop would have been hit right there. But because it's a holiday, yesterday, it's post-holiday, it's the AM session, I'm not in that trade. Did I lose? Nope. Did I teach you how that would have hurt me without actually hurting myself? Yes. Did you learn the context and appreciation for not pushing it in this environment? I don't need to push the button to teach that to you. I can tell you this is going to be problematic. This is going to be a good trading opportunity. We're in low resistance liquidity run, or we're not. And if you can't see the benefit in that, like I don't know how to bridge that gap for folks that just can't appreciate sound logic. Like there's no need for me to be taking risk to prove to you something doesn't work. How many examples you have to see where we're being protective but not trying to assume any positions in an environment that's not conducive for them to be high probability, and then being thankful that it didn't happen and the market didn't deliver in a manner that even myself would expect. I would love to have been in something like this when I was toying, because I would have been in this day all day long trying to do something and hurt myself. All right, so now we have that gap. This should act as potentially an inversion fair value gap on the basis of time. If we get back above these highs right in here, these bodies, we run through that. If we ran through it, if it touches it one more time, it would have to go through the rejection block first, then touch it. That would likely send off a buy run up into this volume imbalance. Listen to what I just said. There's context there. Nasdaq is a riddle today. Where did the bodies, candles, respect? They didn't go below the midpoint of this wick or tail. Rejection blocks taken. Do we touch this level again? If it does, it would be treated as an inversion fair value gap. Bring right to the volume imbalance. So watch this volume imbalance again, trading above it. If it touches it, we'll use the same idea that we're using down here. If it was to come back down and touch this level, that could have been used as an entry for a tape reading long, not demo, not combine, challenge entry. I'd like to see this area over here stay open. So no return back into this area here. It can be responsive right there on that candle's high, right there. In other words, it should hit it and react and go higher. Use this area as a inversion and rip up into this level here. Remember, this is the upside above we were looking at when it was running here. If it were to leave this portion open right in here, that could be breakaway. Just not a lot of clean price action to work with in the Nasdaq, despite wanting to know what liquidity it wants to reach for. So far, it's held up. that this was the stronger one this morning. The laggard, the weaker one, is the S&P. I suspect that if we take this high out here, there'll be a really nice short squeeze run up into the highs here. A little bit more for Nasdaq. And it's delivered to its buy side. Before you can get to finding entries and precision entries and stop loss placement and stuff, there's your buy side. You want to screenshot your Nasdaq chart right now and go back through all this. Go back through all this price action here and remind yourself in your annotations that you knew that this was the upside leader. This was the relative strength leader for Nasdaq versus ES. So longs would be more favorable in this one. It would be more likely that this one would deliver, as I mentioned in the first few minutes of this live stream. And this is the one that's being the laggard. Okay, so I'm watching two levels in here. The midpoint of this wick, which is consequent encroachment, and the volume imbalance. So this delivery is being supported by the halfway point of this wick, the volume imbalance, and the order block. So price should not go below half of this down close candle. That's how I would use it. 3 PD arrays or your ass is next. The question comes in is which one would you use? And I'm not saying buy it, folks. Listen to what I'm saying. If you were going to be using any one of those PD arrays, would you go long at the volume imbalance? Would you expect price to go up from the volume imbalance? Would you expect it to go up from the consequent encroachment of this wick? let me draw it out. So 45.12 is your level for consequent encroachment. Volume balance, mean threshold. So longs, or the idea of watching bullish price delivery, should stay inside of this range of this down close candle, but the no closing price should go below the midpoint of that down close candle. That's basically what I'm getting at. If it does do that, if it does support the idea of that, that keeps everything bullish and that this high would not prevent price from going any higher, and we would look for it to trade into here. So it's kind of like you're weighing price action. Every time it does something higher, you look back and say, okay, where can it return back to safely and not undermine the underlying delivery of price? On a day like today makes it difficult to do that, but that's what my mind is cycling through, looking at price right now. So I like the idea that this candle closed right on the volume imbalance. And we opened here, and I would want to see this one really try to get above the consequent encroachment level, and then you can use it as support and then start running. That would be favorable for continuation on the upside. I'm watching the halfway points of these tails in here. And we're looking at the laggard also. So the upside leader, the stronger of the two indices, found its way up to its buy side. This one, when you're looking at, or if you're observing or studying the weaker of the two, one of the things you have in your notes is you have to allow for a little bit more reluctance in price. It won't be so snappy, like real quick responsiveness to a discount array, something that would support price. It can just meander around a little bit and then eventually start moving up. That's the frustrating part about trading when you don't understand the characteristics of trading in a strong market, relatively strong from a correlation stance, versus a market that's closely correlated but moving in sympathy after the fact, which is my six sister concept, where it's likely to go up there, it's likely to go higher, it's likely to move in sympathy with what the other one did, but it's going to be met with a lot of opposition, which would make it what? A low resistance liquidity run or a high resistance liquidity run? High resistance liquidity run. So it can get there, but it's going to go there. You know, I gave a story about when I was getting my CDL, I had to go take a Greyhound bus, and I've never taken a Greyhound bus ever in my life, but I had to go down to Charlottesville in Carolina, and the trip was supposed to be, less than 10 hours, and it took me like 18 hours, and a guy falling asleep on my shoulder, drooling on me, and I didn't go to the bathroom the whole time, and sipped the same water bottle because I was afraid if I drank anymore I'd want to go to the bathroom. When I got up, my legs and my ass were completely numb. So my expectation going on that trip was it should take this long. But in reality, it was horrendous. It was so long because they kept adding stops and stuff, and I was getting pissed off. I'm like, what is going on here? Why won't this thing get me to where I got to go? Why keep adding stops? And the driver's like, well, this is what we have to do. I've never rode a Greyhound bus ever again, and I never will. Okay, it doesn't work like that. So high resistance liquidity run signatures are much like that, where they'll get you where you think it's going to go, but it's going to get there on a time schedule that you're probably not going to be comfortable enduring. So when we do analysis, we want to do a lot of work in determining which one is the leader, which one's the laggard, which one has the signatures that are supporting continuation, which one has unfulfilled, either premium, in this case, a premium array here and up here. They're unfulfilled. It's like unfinished business, basically. So we have to submit to a whole lot of discomfort, like all this business in here. Like, for instance, if you were just using the midpoint, which is the mean threshold I was talking about, that order block, if you went long there and you took your profits right at this high that's being breached right here, that right there is a nice little bread and butter setup. There's your 5 handles right there. We've taken out that high, and we want to see, does it have speed above this high into this gap? I don't want to show that red because it looks like I'm expecting it to go down. That's not what I'm suggesting. Let's do this. If you're learning today, it would be a great deal of encouragement as your educator and your mentor if you give this video a thumbs up. It doesn't mean everything is perfect. It doesn't mean that you're worshiping me. It just means that you're being receptive to the idea that what I'm explaining real time, how price should behave, and how you should be thinking about it, and how you should submit to it from a mindset standpoint. Just hit the thumbs up, and that way it'll help me determine the direction of these live streams, because we'll be doing more of them as we go into the November month before I take my holiday break. So we're trading into that imbalance I mentioned here. We've taken the buy side again in a higher high here. So you want to screenshot your S&P chart right now. So now again, I mentioned I want to see speed through here. I don't want to see any kind of like meandering around like it did down here. We don't want to see that. They don't want to let the traders that are short off the hook. They want their stops sitting there waiting to be taken out right here. Who's up there? Funds. Oh, they don't trade off a 1 minute chart. They're not using a 1 minute chart, but their order flow is resting right there. I read a guy's comment saying that I use retail stuff for looking at order flow and liquidity. I didn't use any of that here today, did I? I wanted to show you which one's stronger. Did a 1 minute chart on Nasdaq. Which one's stronger? The volume and balance right here. Look at the bodies. Remember, I'm telling you, look at that. We have a fair value gap. Order block hits it, rallies. We're over here. It's moving up, but it's moving at a pace that's being met with rally, pause, work out the idea of the PD array. Is it going to hold? Is it going to use it to consolidate? And then tears through it. So now we want to see it leave this area with momentum and speed to get up into here. Because as it gets higher, any stops up here, they're going to be like, okay, I'm going to collapse on trade and get out. They don't usually let that type of thing happen. What I was going to do here. Oh, I was going to measure that mean threshold for you so you can see it. So it's down closed candle, the entire range. There's mean threshold. So I told you that live. Watch that. That'd be a sensitive price point. It shouldn't go down below that. It didn't. And prices ran from there 7 handles plus. So show me something live. And there you go. But you didn't push the button, ICT. I'm pushing all kinds of buttons today. You just don't see it. They'll talk about it later on now. I'm trying to stay with you until it hits that buy side. So I mentioned earlier, I said I wanted to see this little area here stay open. If it stayed open, that would act as a breakaway gap, basically. So on your chart, you would have it annotated something like this. So that's what it would look like right there. Let me just maximize the chart. There we go. So this is the bottom of that daily. Let me go up to the daily real quick so that way you can calibrate your focus. Oops, I'm sorry, I did the wrong time frame. Too many monitors. I'm disoriented now. Hang on. This inefficiency, I'm not sure where I got that from. Hold on. Let me go back into 1 minute chart because I want you to see it delivered to the buy side. UCD is flaring right now. There you go. So you want to screenshot your S&P there. There's some randomness. So we had the buy side taken here. I walked you through all of this in here. This is the silver bullet between 11 and 10. I outlined how you would use it using the three different PD arrays. Let's go here. That's worthy of a thumbs up, I think, isn't it? And then we're going to do another one at 10 o'clock. So in between 10 o'clock, we're looking for a fair value gap within a bias, drawing towards liquidity. We were not able to get below, meaningfully below this candle's tail. The bodies were telling you the narrative that they were not willing to go lower. Price rallied up. I had your attention on this gap here initially. If it was a trade back down to it, we would treat it as inversion fair value gap. It rallied through it. Told you we would use this level here as a means of instigating a higher price run. If it touched it again, didn't do that. It rallied. Now, that right there, that factor in reading price, you want to record that as they were potential observations. Don't wipe it aside saying, okay, let me just focus on everything else that did work. In your journal, you want to say, I would have been using, remember this is the range I had on it at the time. And you can go back and watch the video. It'll be on the channel. I had it, I think it was red at the time. But I had this range here, and I said if we went above it, I would expect it. If it hit this, that would be sensitive and allow it to send price higher to attack here, drawing up into the volume imbalance, and then eventually into this area here. It didn't touch it again. Once it left it, it stayed open, which is, again, why I lent the experience of showing you that this would probably be a breakaway gap. I want to see it stay open. Why? Because it didn't offer support at a level that it should have offered it. In other words, the algorithm forgot to even refer to this one, right? I'm personifying it, being facetious. The market rallied, said, no, I'm not interested in going back here. We went outside of the daily volume imbalance, which are these two blue lines here. I said, okay, we can. If we touch that, that also could be a factor to allow a sensitive reaction where price could be used to go higher. Didn't do that one either. Because I had both of those, this is for the folks that are asking, how do you know when a breakaway gap? I looked at two different instances where I would normally expect, if say I was long, say I went long, say I had a trade on, I would have bought more and pyramided it on an entry touching this level here. Once it went up like that, if it would have came back down and touched it there, I would have added more. If it didn't do that and it did what it did here and it came back and touched on the top level, this blue line, which are again the daily volume imbalance levels. If it would have touched that, that would have been a point where I would have added more on pyramid. So when you look at my videos and you don't really know, what is he buying? Why is he buying there? Why is he adding more there? It doesn't make any sense, because you're trying to use the 2022 model. You're trying to use optimal trade entry. You're trying to use order blocks all the time. You're taking your limited exposure to what I've been teaching, not knowing all the other facets to order flow, because this is real order flow. No DOM, none of the other stuff's required. But I'm using what I've already taught you, and I'm measuring the importance of how price either wants to come back to a level I would expect it to be delivering to. The fact that it doesn't deliver to it doesn't mean it's failure. It's insightful. That's a graduated understanding. I know that there's a Tom, Dick, and Harry somewhere, and there's certainly some asshat down in Texas sitting here watching this today, but he's pissed off right now because that buy side just got hit right after I outlined the silver bullet live again, baby. Where's your live streams at? Maximum loss day. Come on, put them back up here. We all love watching it. But context gets lost in this simply me doing a execution video, pyramiding and building it up. You have to have all the storyline behind price action, and you have to see it conceptually shared, not just write a paragraph about it, make a video about it. Like, it has to be done real time. So while many of you are excited to get these books I'm putting out, it does not take away the necessity of you going in here doing this type of thing here, where you're tape reading, you're observing. And because both of those instances of this candle going up and not coming back down and offering another potential entry, it didn't give it to me there. It didn't do it at the high end of the volume imbalance level. We ripped higher, right into the volume imbalance. I said, okay, we went right up into the volume imbalance. That means I'd like to see this stay open now, because it's broken away from all of this structure here off of a higher time frame PDR, right, which is the volume imbalance, these two blue levels here. When I'm done jawboning, I'll take you back up to the chart so you can see what that is again. But having that in your chart on a higher time frame and then showing it visible on all time frames subordinate to it, that means lower, like a 4 hour, hourly, 15, 5, 1, whatever it is you're looking at, seconds chart. It allows you to trust what you're looking at. So while we were allowing for the market to go lower, it showed no willingness to do so. And we had what here? This short-term high being taken to the upside is what? A shift in market structure, when Nasdaq was still wanting to go higher. So now we're seeing the beginning stages of what I was referring to earlier today, where when there's symmetry that's disconnected and disjointed, which is typically after a large range day, the next morning session will be like that, where it's disjointed, or after a holiday, where normal business of trading and normal business hours and normal order flow and volume that would come into the marketplace, if it's not a full session, or if it was entirely not permitted at all, they're going to have this model that it's used that causes disruption in symmetry, where in the morning session you have to sit on your hands and wait until the market starts showing signs of symmetry, where they start to agree with one another. And once that happens, even if you miss the best mover, which is Nasdaq, which we talked about on the upside, there was a lot of give and take back and forth on that, even though it went higher. That's fine. You can go to the sixth sister, which is the ES here today, and I drew your attention to this area right in here. The down close candle, mean threshold. It did not close below it. We wicked into it, rallied it back above, took the buy side, traded right into this area where it had the wick or tail that candle right there. That's what this line is. That's what it's anchored to right there. So it's half of that candle's body. I'm sorry, half of that candle's wick or tail. See, son, I told you. I told you I'd get it mixed up. And then it's this fair value gap here too. So I liked both of those in agreement. So we saw it careen right into that. Look at the bodies right there. See how it's respecting that? And we came back down. We went above it, and look what we did there. Boom, we touched it. That's inversion fair value gap. And I said we would want to see it just run right up into it, so that way they can't pull their orders right there. No depth of markets necessary. This is real institutional order flow. Folks, you cannot fake real time. You all watched me do it live in front of you. I walked you through the adversities of this morning. I explained to you with great detail why I teach you not to trade in the morning session, but also taught you one more facet to it that will be in my book, but you won't appreciate that chapter having not been here watching me do this one, because I will be referring to this video in that chapter. I'll say go to this video, and it'll be beneficial for you to see this. Don't think that you're going to watch, or not watch, but don't think you're going to read these books that I'm putting out, and all of a sudden the tumblers are going to click together, because you still have to be in these charts. And there's going to be people still pissing and moaning that I'm hiding it from you, and I'm not. I'm literally spelling it out. But your experience, seeing it, studying it, journaling it, and being exposed to it by repetition, that recognition is a response, a natural default response to you being repetitively presented in front of the charts over and over and over again, seeing it, taking little snapshots of it. All these little spaces in the chart, there's no candlesticks or anything annotated in it. Use that space to type out. I was expecting it to trade down here, and if it would have did that, that would have been a buy. It didn't do that. And when it went above here, I would expect it to trade down to that level too. If it did that, I would have done that. Like it did this right here, where we opened right there, and we traded down to the top of the fair value gap there. Folks, that's not support resistance. I don't give a shit what Texan boy down here talks about. That's not support resistance, man. That's institutional order flow. That's not anywhere else. You can't see support resistance in that. But that very function right there is what I was referring to. If it was to touch this, when this candle went up, if the next candle would have went down, or a candle after that would have touched that blue shaded area, that same response that we're seeing right there, that's what I was referring to there. That's a sensitive response. I would expect price to deliver on the basis of, buy side, in other words, moving higher after it did that. But it didn't do it. Doesn't mean failure. It just means, okay, let me see what else it's going to do next. Well, the next one was the volume balance high. The same thing. If this candle would have traded down and touched it there, the same response we see right there. That right there is how an inversion fair value gap works. That right there is exactly how an inversion breaker or inversion, any PD array can be inversion levels. But they're not zones. They're very, very specific price points. There's 3 of them: the highest, the lowest, and the midpoint. You're complicating it. I'm not complicating it. But you're also trying to many times rush yourself through all this required learning of sitting in front of price action and studying it, doing nothing but observing. That's all this is, folks. You're conditioning yourself by repetition to see it. And by doing that, you will recognize the things that you're taking snapshots of. You'll be able to walk out and see it live and call it just like you watched me do today. This is not a skill set that's going to evade you if you do what I tell you to do. How long is it going to take you to do it? I don't know. But you have to submit to that length of time that's required for you. That's uniquely your rolling pathway, your learning curve. It's going to be whatever it is for you. And don't be mad at it. Because when you get it, it will feel like it wasn't that big of a deal once you get there. When you look back and think, man, I think it's going to take forever. And it doesn't take forever. It might take a couple years to get really, really good and so precise that you can see it like this on a 1-minute chart. But if you can do it on a 1-minute chart with lots of experience, it gives you so many examples. That's why you should be, whether you want to trade with a 1-minute chart or not, you may not be a person that wants to trade the ES. A lot of you are saying in the comment section, please go back to Forex. Please go back to Forex. Can you just listen to me about price delivery here? Because it's the same stuff in Eurodollar. It's the same stuff in the British pound. It's the same stuff in the Japanese yen. It's the same stuff in everything. But if you don't study it and practice it, you won't see that. And you're wasting the opportunities of being in front of me or having me in front of you live like this, because I'm not talking about the thing that you trade. But price is the same. All of these markets are running on the algorithm. I mean, that's the reality. That's what's going on. Buying and selling pressure has absolutely no bearing on what you watched today. It's all time and price. I literally showed you how to utilize even in a sloppy day. I told you that silver bullet forms every day. But you're not going to see it with limited exposure or experience. I walked you through this one here. That's the fair value gap right there. Right there. Where's the stop got to be? It's got to be below that candle's low. Why? Because that's the low that makes the fair value gap low end parameter. That's the high of that candle is the low of the fair value gap. Also, it's protected because you're below the mean threshold of that down close candle, which is a bullish order block. Does your chart show this here? Did your chart do the same thing I was telling you mine was going to do before it happened in real time in front of all of you? I'm quite certain your chart looks just like this or very similar to it. And when you know this skill set, you will be able to predict the future just like I did in front of all of you. I have veteran students that can do this day in and day out. It's transferable knowledge. If I didn't have that, I would tell you. For whatever reason, none of my students can learn this. But they can, they did, and they have. And they use it and they make real fucking money. So I don't know what else to tell you, but just roll your sleeves up and submit to this process. It's going to take you much more time than you want it to, but it's worth it. It's absolutely worth it. Sorry, son. But that's going to be it for today. Hopefully you found it insightful. If it was helpful to you, if you learned something today, if it helped you graduate in your understanding about what it is I teach about institutional order flow, real market making concepts, and how the algorithm absolutely books price,